Hello, everyone, and a very good evening to all of you that are actually joining us here for our webinar. Tonight, we'll actually be having our first webinar of the Back to Basics series called Why Trading Matters. So, thank you so much for all of you who are here on time. I hope you managed to actually scan the QR code that you see on your screen right now, because that will bring you to our page where you're able to see more insights and hopefully also be able to learn a little bit more about trading even as we embark on this journey together. So without further ado, we'll actually begin tonight's webinar session right now. And I'd like to start off first of all with a few important disclosures and disclaimers. So tonight, actually, we are going to be looking at why trading matters. This is a beginner-friendly series, talking about the basics of trading. And before we even start trading, of course, all of us need to know what are some of the fundamentals, what are some of the things to look out for so that we gain a little bit of confidence. So this is the first of the series, like I mentioned. And we have some important notes for you to take note of course, some disclaimer lines. And a quick introduction to the team. So our team, my name is Chunkin or CK. I'm a markets analyst here at OCBC Securities. So together with me and my colleague Samuel, we'll actually be walking you through this webinar series over the course of the year. We have quite a few sessions ahead that I'll run through. And of course, tapping onto our experience, tapping onto Sam's experience also as a former as a former hedge fund manager, we'll be looking at how we can actually take a look at certain things that are happening in the market to leverage on that, leverage on the team's expertise as well to help you along your trading journey. So the main topics that we'll be covering today, first of all, like I mentioned, we'll be giving an introduction to the series. We'll be talking about the problems that we face today, why you might want to consider trading, and in particular, what aspects of trading that might appeal to you. So what we have in store for you over the course of the entire series, not just over today. And then we'll be zooming in actually to some of the very basics at the core of trading. So we'll be looking at the difference between trading and investing. We'll be looking at what the market looks like right now, why there could be a case for short-term trading or for long-term investing. We'll be looking at some terminologies that we use actually as traders. And after that, going into a little bit more detail into some of the things to look out for. So what are asset classes? What are stocks? What are bonds? How bonds could affect stocks, things like that. Although we wouldn't go into too much detail because we would save that for future sessions. Subsequently, we'll be looking also at zooming into the stock market. What are some of the things to look out for? So things like sectors, some introduction to the biggest companies out there, and of course, a sneak peek to what we'll be covering in the next session. So why trading matters part 2, where we'll be talking about what moves the markets, what are things to look out for. So we'll be going into that in a little bit briefly, actually, this round, but a lot more detail, of course, in the next session. So maybe before we begin today's session, just a quick note also that there is a Q&A box that you can fill in, or there's a chat box that you can fill in as well. And at the end of the session, if you have any questions, feel free to drop them into the chat box at any point in time, and I'll try to answer them as best I can at the end of the session. Otherwise, we'll be able to refer you to the right parties as well so that we are able to help you. So feel free to ask any questions that you might have along the way, and I'll try to address these questions at the end during a Q&A session. Okay, so we'll start off actually today's webinar. I'll try to keep it short, although we are covering a lot of things today. But what we are going to be looking at first of all is actually the problems that we face today and why we actually kickstarted this webinar series, the Back to Basics series. So we look at two problems that we face today, and actually what we have is people like beginner Bob, people like you and me, maybe when we start out on our trading journeys or investing journeys. So you might be a fresh grad coming out of uni. You might be somebody who's earning his NS allowance for the first time and wanting to know what to do with it. All of us would start from somewhere. And so let's call this person beginner Bob. What are the problems that beginner Bob faces when he wants to start trading or investing? Well, the first big question, of course, all of us would have when we start out would be, where and how do I start? What even is trading? What even is investing? Where do I start? Where do I even look for resources to learn where to start? The next thing, of course, beginning my first trade, how do I trade? How do I click onto the platform, create an account, and make my first trade? of course, looking at some of the many terminologies out there that finance professionals and investment professionals use out there, then wanting to know what are the very basics of trading and investing. What's the difference even between trading and investing long term? And why should I favor one over the other? So we have beginner Bob, and the problem with beginner Bob is really finding out where to start. And that's where many of us are right now. You might have just opened an account with OCBC Securities, or otherwise reactivated it, and that's where we want to really begin in the Back to Basics series. And for those of you who are maybe a little bit more experienced, it's always good to have a refresher to know what are the fundamentals and the basics of trading before we even get a little bit more advanced. Now, next, we also have an intermediate trader or intermediate investor, maybe 2 to 3 years in the workforce. You have earned a little bit of a paycheck right now. And the question is, maybe I have an idea of what I want to do. I want to buy into an ETF. I want to buy into some blue chip stocks. But the problem is I don't have time to follow the markets. What should I look out for? And we actually mentioned it in many of our previous engagement events as well. One of the problems we face these days is actually that we have too much information, not enough. And so how do I sift through all this information when I don't even have time to myself? And I'm so busy at work, I'm so busy with my family commitments. What do I do to follow the markets easily? So I'm looking for something that's convenient, something that's easy, something that allows me to quickly make decisions. And that's where we also want to cater to you and tell you what are the things you really need to look out for. What are the things that other hedge funds, traders, and investors are looking out for. So that's where we are today when we come up with the Back to Basics series, Time and Know-How, and we are aiming to actually, through this series, help you along this journey. But of course, to begin with, I'd like to congratulate all of you guys because making the first step of just joining the webinar is, of course, the hardest step to do. So with that, we'll be looking at what we have in store for you in terms of content. So this is the tentative content that we have for you. We'll be looking at maybe 9 to 10 part series over the course of the year, once a month, every third Monday. And we'll be looking at why trading matters, of course, for the next this session and the next session. We'll be then going into technical analysis. We'll explain a little bit about what technical analysis is today before we actually go into it proper and talk about trend lines, indicators, how do I know what's something that's overbought, oversold, and to trade. We'll be talking about using the platform, risk management, and certain tools and tips that we have as traders. Looking at, of course, beyond Singapore SGX, what are some of the things to consider looking at the Hong Kong and US markets or foreign markets in particular. And hopefully, actually, by the end of the year, we also have in plan for you guys some engagement from our futures and FX colleagues at the desk, as well as our products group, bonds and ETFs, so that we get a holistic idea of what are the products out there beyond just stocks. But we'll begin with stocks right now, and that's the aim of today's session. So we are talking about why trading matters. We are talking about, in particular, the stock market. And all of this is to help you build confidence in making that first trade. So we'll begin the webinar right now actually talking about trading, and we'll be talking about, in particular, what is trading? Trading versus investing. So trading, what is trading actually? And how does it compare against investing in the long term? Many of us have probably heard these terms before. Well, at its very core, trading and investing actually aim to do the same thing. They aim to profit off movements in the stock market. So the first big difference is actually in terms of time frame. So trading tends to be short-term oriented. It could be intraday, trading before the session even closes within the day. It could be within the week. So yeah, maybe trading over the session, 3 to 5 sessions. It could be even a little bit longer than that. But generally, trading tends to be very short-term. Now compare that to investing, which tends to be a little bit longer term. So 1 year, 3 years, 5 years, maybe even for retirement, which could be many years in the future. But the whole idea is the same. We intend to profit off movements in the stock market. The question is just the time frame. Now the next big difference actually is the mindset and the strategy of traders versus investors. So in trading, we are looking at in and out, quick trades, short term, right? So we're looking at maybe possibly even going on leverage or doing contra trading. Some of these terms you will get familiar with. But the idea of trading is to do short-term movements. So volatility becomes very important in trading. Now, as you compare that to investing, you have probably heard of the term buy and hold, or you have heard of the term dollar cost averaging. These are concepts that are for the longer term. And so that's a buy and hold strategy and focus for investing. And it's not to say that buy and hold is wrong, but we will explore why there could be a case for either. Now, lastly, the tools that we use when it comes to trading and investing tend to be a little bit different as well. And so the question is, how do I profit off movements in the stock market, right? So the focus of trading tends to be on technical analysis, which is like what I mentioned briefly earlier, things like trend lines, technical indicators. So you have your MACD, RSI, moving averages, your different plotting of trend lines and tools, charting tools. On the other hand, for investing, because it tends to be longer term, you have things that analysts come up with, for example, target prices over 12 months. And so that is the focus of fundamental analysis, that you will look at maybe the balance sheet, you will look at accounting statements, and with that, you come up with certain models that help you get your target price. So again, nothing wrong with either approach. It's just what might be more in favor or what you might prefer as you begin your journey, whether trading or investing. And key to know, of course, with all of this in mind, what you want to really focus on when looking at the stock market. So we look at actually some studies out there on why there could be a case for trading and the problems with fundamental analysis as it stands right now. So this is a 2012 study actually performed on 11,000 analysts over 41 countries, talking about the overall accuracy for target prices. And are target prices really always accurate? We have these finance professionals with degrees and other professional qualifications looking at models and looking at how target prices could be something that could be worth your time. But if you look at the overall accuracy from this 2012 study, we actually see that over a 3-month horizon, target prices are only accurate 18% of the time. And if you compare that to a 12-month horizon, slightly better, but only 30% of the time. Now, why is that so? Why is it that, even these financial professionals don't get their target prices right all the time? Well, if you think about it, that's simply because using some common sense, well, a lot can change over 3 months or a lot can change over 12 months. If you just look at 12 months ago, at the start of 2021, where were you right then? And how was the US Federal Reserve, for example, acting at that point in time? What was the outlook for the global macroeconomics and for your company at stake? And it's not surprising that target prices 12 months ago might not be fully accurate. So analysts are also aware of that. They constantly revise and change their target prices because of new information. And that's exactly why trading could be something that's interesting to you, because it's all acting on recent and new information as well, as we'll explore. Now let's take a look at some other statistics on the market conditions right now and why possibly because of the trading climate right now, it's no longer about the fundamentals. So majority of equity investors or stock market investors today don't actually buy or sell stocks based solely on stock-specific fundamentals, based solely on a company's balance sheet. It's usually a mix of many things. So actually there was a study, you can see the sources down there, CNBC and JP Morgan, they did a study and they say that actually fundamental discretionary traders, people who only look purely at the fundamentals, they only account for about 10% of trading volume in stocks. And meanwhile, some of you might be familiar with terms like ETFs, passive investing. Well, that has grown in huge popularity over the past few years, over the past decade as well. And passive and quantitative investing now accounts for about 60% of the entire market. So it's more than double the share a decade ago. Of course, with passive investing, the investor might not need to do much. But for the active investor, knowing that these passive investors are out there, it certainly changes how you interact with the market. Same thing for quantitative investing. People who use algorithms, people who use certain rules to trade the market. Now, these are no longer just looking at fundamentals anymore, are they? And meanwhile, let's take a look at the stock market that we are familiar with since the start of COVID, since 2020. So this is a chart of there are two charts actually on this slide. The first is called the VIX index or the volatility index. This is a measurement of the volatility, especially in the US, in the S&P 500. Next, of course, we have quite straightforward actually, the daily changes in the S&P 500 in terms of percentage. And we can see, of course, in the March 2020 crash when the stock market was huge, experiencing huge volatility. The VIX went up, the daily percentage changes in the S&P 500, you have huge swings across the days. On one day, you're having a record loss. On the other day, you're having a record profit. So this is the kind of environment that we are actually dealing with right now. The current climate is filled with volatility. It's filled with a lot of uncertainty as people try and digest all the different things that are happening in the markets. Just look at what's happening right now in terms of Russia, Ukraine, in terms of the China slowing of economy, in terms of what the US Fed is going to do about inflation as well. So there are huge swings in the market. It has come down a little bit since 2020, but this is the current market regime that we are actually living in and dealing with. And so something like technical analysis, being a little bit more up to date, not just looking at the balance sheet, but also looking at what's the new sentiment out there, what's the different policies out there that are impacting you, what are even the hedge funds and algo traders out there doing. These could be tools that might equip you a little bit better to deal with the current climate right now. And let's let the stock market actually speak for itself. This again is a chart since 2020. So we're actually looking at the 2020 March crash. And we have seen how over the course of 1 month, because of COVID, it has come down 35%. And subsequently, over the next 3 months, it actually came up 47%, recovering almost all of its losses. Of course, now we know in 2022, we are at record highs once again before the stock market has actually corrected a little bit. So what kind of market are we living in or dealing with right now? And it's a question really you can ask yourself whether you rather trade or invest in this market. Now, of course, for investors, people who invested before 2019, before 2020, you would maybe average down because of the stock market volatility and correction, or the bear market, although it was short-lived. You will want to ride out this volatility. But there are people among us as well who want to profit off this volatility, trade off this volatility. And there are opportunities out there for whatever kind of investor or trader you are, as long as you're aware of it. So now we go into some of the terminology of trading and also of investing actually. And of course, we are looking at how, we have already talked about the cases for investing or trading, what kind of market we are in right now. So let's take a quick look at some terminology to kickstart our trading or investing journey. So first of all, the terms long and short, what do they mean? And you often hear it or see it in the news as well. So just quickly going through it right now. What is long when it comes to trading or investing? Well, when you buy a stock, you are long a stock. So you will see, for example, if you buy into a mutual fund and it says long only, these funds are only allowed to buy stocks and not to short them, as we'll go through later. Of course, after they buy it, they can sell it, but they have to only buy stocks first. They are long only funds. So generally, people would want to buy low and sell high. And so you would think that the price would go up if you are long a stock. And so you would buy it. You would be long a stock if you think it will go up. Now the inverse, of course, is quite straightforward. We are talking about selling a stock. We are talking about shorting a stock. You sell a stock, you are short because you think that the price will go down. And so that's the very core of any trader or investor actually. You want to profit off the market. You want to buy low and sell high. And that's the very core of it. Now, of course, how you go about doing it, there are some people who engage in this thing called short selling. And short selling is actually for people who sell shares first before buying it. So it's the same concept, buy low, sell high, just that you are selling high first. And of course, hoping that the stock price maybe comes down before you buy it. Now you might ask, how does this work? Because how can you sell something that you don't own? So there are two ways to actually do it. One is a covered short. And this is probably the safest and most well-used way, I could say, which is really to borrow the stock from somebody who already owns it. So you borrow the stock, you sell the stock. When the price hopefully goes lower, you buy back the stock at a lower price, you have made a profit, and then you return the stock to the lender. Now, of course, whoever lends you the stock will demand an interest for it. And if you're interested to find out a little bit more about this covered short or share-based lending schemes, you can approach your trading representatives and I'm sure they'll be happy to explain more to you. But this is the whole idea. If the stock market goes up, you buy first, you're long a stock, and then you sell it and take profit afterward. But if you think otherwise, you think that the stock market might come down, this could be one way for you to profit off both directions of the market. Now, of course, there's this other concept which is called naked short or uncovered short, and this is a practice that's generally frowned upon. So what happens in a naked short is you're actually selling something that you don't have, and if you're not able to actually cover it or to deliver your stock, there will be a penalty in Singapore for naked short sales. So the whole idea is when you buy a stock, somebody else is selling the stock to you. And so you expect somebody who's selling the stock to you to actually be able to deliver the stock to you. And so there are penalties otherwise. Again, if you're interested in dealing with short selling, in dealing especially in this area because of the penalties, you might want to find out a little bit more from your trading representatives. But otherwise, the whole concept of selling is really to sell high and buy low later. That's the concept of shorting as well. So there's long and short, and hopefully this gives you a little bit of insight into just some of the terms. But of course, we'll go through other terms later as well when it comes to the stock market. But at its very core, buying and selling, that's what trading and investing is all about. Now, there's this concept that's quite popular in Singapore especially, which is this concept of contra trading. What is it, you might ask? Especially for those of us who are just starting out. This sounds like something that you might have heard on the streets, but not something that you actually know what it is talking about. Well, today, hopefully, after this session, you get a little bit of a better idea. Contra trading at its core is actually to buy and sell shares without paying for it. So if you remember in my previous slide, we talked about how short selling, you have a time to deliver or a settlement period. Usually it's about 2 days, for example. Well, in contra trading, what happens is when you buy a share, you normally have to pay up and settle the trade within the next few days. But in contra trading, you buy and sell trades can offset each other. And so you don't actually need to pick up, you don't actually need to pay for the full amount that you might have bought. So for example, if I buy $100 of stock X, well, before I settle the trade, I sell it and I might have sold it at maybe 101. And so I profit off that $1. I just need to get that $1 difference. That's the whole idea about contra trading. Again, the whole idea is to have, quick trades without putting any cash up front. That might be something that some of you might be interested in. And if you have any questions about contra trading, again, approach your trading representatives. They'll be able to explain using real life examples and go into a lot more detail with you as well. So this is just a quick primer for you to catch a glimpse of what people are doing out there. Okay, so hopefully I'm not going too fast. Again, if you have any questions at any point in time, do feel free to drop it into the chat. I will help to address some of these questions at the end of the session. Right now, we are going into another topic. So I am going quite fast, but we'll be looking at asset classes right now. And the whole idea of today's session really is to kind of condense a lot of different topics so that at least after today's session, you get an idea of what stock trading or investing is about. And after the next session, we'll actually be talking about what things to look out for. Yeah. So the very basics of stock trading or equities trading, or in fact, before we even go into equities, we look at something called asset classes. What are asset classes? Well, an asset class, generally speaking, is a group of investments or financial instruments. They exhibit similar characteristics. Now, I give you some examples of asset classes that might be able to make it more relatable to you. So commonly traded asset classes, equities or stocks, that's something that we all have our eyes on, of course. Fixed income or bonds, REITs, and commodities. So what do I mean by similar characteristics? We are looking at, for example, for stocks, something similar is they're all traded on an exchange, or stocks could give dividends if they choose to. Something similar for bonds or fixed income is something like, in terms of a company debt structure, they are considered as debt rather than equity. So they are considered at a certain priority. Also, bonds tend to have a structure where they pay out coupons in exchange or interest in exchange for you actually holding that bond. So things like that. This is where asset classes look like. We'll go into different asset classes in a bit more detail in future sessions. But of course, we'll be zooming into equities, of course, because that is what we are all interested in today. Equities, known as stocks and shares, they represent an ownership in the company. So an investor like you and me, we want to own maybe a piece of a company like Apple. What we do is we actually buy a stock and we are actually now an owner of the company. So we are buying a small piece of the company. Now, subsequently, of course, now you're a shareholder, you own the stock or share. If the company's stock increases in value because you made a good investment, you can sell the stock for a profit. And so these are some examples of some Singapore listed shares or stocks: Sheng Siong, DBS, CapitaLand, now CapitaLand Investment, Singtel, SIA, your other banks as well, even OCBC as well. So we are like all these stocks, all these companies, they list their shares on the stock exchange, in this case SGX, and it allows investors like you and me to participate in what the company is doing. If the company is doing well, it earns a lot of profits, well, investors are rewarded in terms of dividends or in terms of the share price going up. And of course, vice versa. If the company is not doing well, the share price usually tends to go down. So this is an example. It's what a page for stocks or equities will look like. This is extracted from Yahoo Finance. Like SPH, you will tend to have a stock price chart. Of course, on our OCBC trading platform, you will have these charting tools as well as some key information like stock price and other metrics as well. So this is just an example slide for you. For example, another company that some of you might be familiar with, Capital Corp. Well, this is what it looks like when it comes to many of the finance websites out there, including Yahoo Finance. We move quite quickly into a brief overview of the other asset classes before we go back into the stock market again. So the other asset classes out there, very commonly, some people would ask about bonds or fixed income. What does it refer to? Well, I referred to it earlier as debt obligations. So the whole idea about bonds is really that when you invest in bonds, you're actually lending money to the bond issuer. The bond issuer can be a government, it can be another corporate or company. But when you invest in bonds, when you hold a bond, you're actually holding debt. So in exchange, the company actually pays bondholders interest in the form of regular payments called coupons. So you will normally see for something like bonds in terms of interest rate or coupons, there's a lot of sensitivity to global interest rates. There's a lot of people that are looking at how much coupon, in terms of the coupon payments, how high it is for certain bonds. But the problem for many of us actually out there is that bonds are usually denominated in large amounts. So you're looking at something like 200,000 US dollars. That makes it difficult for many people like you and me. The average retail investor, although there are exceptions, there are examples of bonds that are called retail bonds that are available for many of us. And one example is actually the Singapore Savings Bond that some of you might be familiar with. So those of us who saved in SSB, what we are actually doing is we are taking out some money. We are actually handing the money over to the government, and the government pays us a regular interest for the cost of the SSB. Next, we move into the asset class REITs, or real estate investment trusts. So a REIT is actually a company that owns or finances real estate. So think of it as being a landlord, for example. So this investment trust, you take together a lot of different REIT owners and actually put it together. And after that, the REIT actually owns certain properties that generate income. So it's just like renting out a property. REITs pay dividends in the form of rental income from the properties that they own or they hold. And these REITs, usually in Singapore, for example, they can be publicly listed. So some examples of the Singapore REITs, of course, Ascenders REIT or Mapletree Logistics Trust or Keppel DC REIT. They own different types of property, logistics property or data centers or office buildings. So the idea is investors like you and me, what we can do is we can do a REIT. The REIT continues to grow and buy into properties underlying it. Subsequently, these properties generate rental income. They are not a property development company. They are just holding it for the rental income. And REITs have to distribute out these dividends or rental income in the form of dividends or payouts to the investors like you and me. And they are mandated to have a certain payout ratio. So majority of these rental income will go back to the investors as well. So this is sometimes considered as a proxy for maybe many of us Singaporeans. We like to own property out there, but that might be out of reach for many of us. This could be considered as an alternative investment. Instead of owning one property, but fully owned by ourselves. We can actually own parts of many different properties by investing into a REIT. And that's the idea about real estate investment trusts. Now, asset classes, we also gave the example of commodities. I'll go quickly through this. We won't really be exploring this as an asset class to invest or trade in, but we'll be looking at it in future sessions as something that actually could impact the stock market, which is what many of us are interested and here for. So commodities could be in the form of something like gold, and it could be physical gold, it could be gold mining stocks, it could be gold certificates or gold ETFs. These are ways that we can actually participate in the commodities market. Same thing for something like silver, same thing for something like iron, metals, or oil. Oil is also a commodity, and we might not be able to physically trade barrels of oil. We don't have space in our houses to put barrels of oil, but instead we can trade and invest in oil by purchasing an oil ETF, or maybe buying into oil stocks, companies like ExxonMobil listed in the US, or Chevron, or even oil futures for those of us who are interested in derivatives and in the futures market. And of course, we won't be buying the barrels of oil themselves, but we are exposed to the oil price if we buy into oil stocks, for example. So it's just for our understanding and for our knowledge that we know commodities are out there, they are frequently traded, they can be very volatile, they are also subject to some of the global macroeconomics out there, things like inflation as well, which we will be talking about in future sessions. But right now, if we're just talking about the stock market and its relation to commodities, maybe these are some of the most direct ways as well. ETFs and stocks that are mining gold, stocks that are pumping oil out of the ground. Now, lastly, we go into something that's not quite an asset class, it's funds. And this could be a way for us to invest or trade in things such as oil, like we mentioned. So there are two types of funds that we'll be actually briefly covering. One is exchange traded funds or ETFs, and the other would be managed funds. So for exchange traded funds, what are they actually? Obviously, they are traded on the exchange as the name suggests, but beyond that, there are many different types of ETFs out there. And a lot of what we normally know about ETFs is that they usually track the performance of an index. Now that could be oil price, that could be gold price, that could be your S&P 500 or your Straits Times index in Singapore or the Hang Seng index in Hong Kong. But the whole idea is these are some examples of ETFs out there, and they are very diverse. And they could be a way for you to actually participate in things that you might not otherwise be able to. Now, for example, for the S&P 500 ETF, that's a way for you to participate in the broader US market, the 500 listed companies on the US exchanges. And it could be very difficult for you to actually purchase all 500 of them on your own as well. So that's one advantage of ETFs that could be worth your attention. Now we have some examples of popular ETF providers. We have ARK Invest, many of you have known, that actually invest in a lot of new disruptive technologies. That was very popular in 2020, but the price actually came down quite a bit in 2021 and all the way up to now. Very popular also by other asset managers like BlackRock, iShares, or following some of these indexes like I mentioned, the S&P 500. Now we contrast that to mutual funds or unit trusts, and we actually look at how some of these funds are actively managed by the fund manager. So some fund managers out there, like I mentioned, we have BlackRock. They do both active and passive. So passive, ETFs, active, mutual funds. But other than that, we also have a lot of these names that we might be familiar with. Maybe we have participated in some of them actually through our investments or insurance or other ways to get exposure to them. And so they are professionally managed. They have fees that are related to this management, fees related to performance of the fund, and they are bought and sold through private channels. So they are not traded on an exchange. It's not listed and the price doesn't change minute by minute, just like an ETF would. But of course, you do get the experience and expertise of a fund manager that helps you manage your money. And certain funds might have certain mandates, wanting to outperform a market, wanting to invest in certain technologies, things like that. So these are some of your common fund houses or fund names: BlackRock, Fidelity, Allianz, Franklin Templeton. Some of these might be familiar to you. So the whole idea of funds, and just now our summary is really because you might be able to use ETFs or mutual funds to actually get exposure to even things like the stock market. Even if you can buy a stock on its own, you might not be able to buy many stocks on your own. You might not be able to buy all 500 companies in S&P 500. That's the whole idea about being able to diversify and use tools like ETFs. Now we move on finally back to the stock market, and we actually look at some of the concepts that are, a little bit more relevant to the stock market. So we look at certain metrics right now. We look at certain things to look out for before we actually finish off this webinar. So we want to equip you actually by the end of this webinar at least to know some of the basics when it comes to stock and trading and the stock market. So we look at, first of all, this concept of market capitalization. Some of us might be familiar with that. We look at it in terms of its definition. We talk about how it means the total value of a company's share. So generally, it refers to the size of a company as well. And this is the formula to calculate it. It's quite straightforward. You just have the number of shares that a company has issued. You compare that to the share price, you multiply it. That is the value of your share, of your company when it comes to market cap. But generally, what's more relevant to us when it comes to trading and investing in the stock market is when it comes to market cap. How does it affect me? Well, generally speaking, we can categorize market cap, or we can categorize companies in terms of their market cap. We can talk about how a company is a small cap company, or a mid cap, large cap, mega cap company. And these are all kind of classifications that investors do that maybe your professional fund managers might be interested in because they can only invest in small cap or only invest in companies with a certain market cap. So we categorize them roughly. The categories, of course, they are not strict categories, but they do vary exchange to exchange. But we look first of all at small cap stocks, and these stocks tend to be a little bit more volatile. They tend to be stocks that have a higher growth potential. I'll give you some examples later on those listed on the SGX, so we get a better grasp of what small cap or mid cap or large cap stocks look like. But generally speaking, these categories, small cap stocks tend to be more volatile. They tend to have higher growth potential. They tend to be companies that maybe in terms of the market cap, less than 300 million. So that's the definition in the US, less than 300 million US dollars. In Singapore, it could be less than 100 million or somewhere between 100 million to a few hundred million. We look at how that contrasts when it comes to a company's priorities and size. We compare that now to mid-cap. So a mid-cap company is a company that has solid growth. It's a company that might be a market cap of maybe 600-700 million or maybe even 1 billion. These companies tend to have less risk than as compared to small cap, but more risk as compared to large cap companies. And large cap companies, some of us are familiar with the blue chips or what we call large cap companies, blue chips. These are companies that have a strong track record. They are large, they are stable. They might even give out things like dividends. In Singapore, we are looking at companies like our local banks. We are looking at companies like SIA. They are very well-established companies. So this is some examples. Okay, these are some examples of companies that fall in all three categories. We have companies such as Propnex, companies like Kofu, companies like Jumbo, listed on the SGX. They are ranging in the few $100 million market cap range. These companies tend to be smaller as compared to their mid-cap and larger cap peers, but also maybe with a little bit higher growth potential, possibly. We have seen some companies also move from small cap status to mid-cap and large cap as they manage to grow bigger and bigger and more profitable and more successful as well. In Singapore, examples of mid-cap could be companies like Sheng Siong or Raffles Medical or maybe Sembcorp, companies that have started to put their fingers everywhere in Singapore, but maybe not so much regionally perhaps, or maybe regionally but not so much globally. So companies that are mid-cap in size, they tend to be in the low billion-dollar range, maybe $2 to $3 billion, $4 billion. Of course, in the US, this definition will change a little bit as well because the US market is a lot deeper and bigger. Now, of course, our large cap companies in the STI, maybe companies that are familiar to us, like DBS, like Singtel, like SIA, well-established multi-billion-dollar companies. And these companies, of course, will be it will have a lot stronger track record, will be a lot more stable. Their share price might not even fluctuate as much as compared to some of the small caps, depending, of course, on the company itself. So these are some categories that you might want to keep in mind, even as you look at stocks. And the first question you can ask when you're looking at whether a stock is worth it to buy or not is, what's the market cap of the stock? This is one metric that you can use to consider. Now, of course, because of market cap, because of the different characteristics that we went through, something like asset allocation can be something that you also want to consider. So different asset classes that we covered and different market cap profiles that we covered, they tend to be skewed differently when it comes to risk and reward. And so something that you can consider on a portfolio level is something called asset allocation. How much do I want to put into small cap stocks? How much money do I want to put into large cap stocks, or into even the stock market as a whole as an asset class, and the rest put maybe into the bond market, things like that. So we always talk about two metrics when it comes to finance, and that is risk and return. And generally speaking, because of these classifications, you can say that, bonds might be lower risk because they are considered as debt obligations. You get an interest rate, it's pretty safe. Of course, that's not guaranteed, but it could be something that's a little bit safer, a little bit lower risk, but lower risk potential. Similar for REITs, because of the dividend payments, you are guaranteed some income. It's just whether your REIT can generate the income. But if it does, because of the laws, because of what it mandates, you are guaranteed some kind of payouts. Things like that. Might be a little bit lower risk, might be a little bit lower return. Now, of course, then we have stocks. We have large cap stocks that might be a little bit safer because they are a little bit more stable, and then followed by small and mid cap stocks. And finally, maybe even foreign stocks, which of course they will follow large and mid cap categories, but beyond that, you also have something to think about, things like exchange rates, things like foreign government policy. So you might have a little bit higher risk. Of course, it might not be the case. They might be, of course, pretty low risk stocks, but generally speaking, it's just something else for you to consider as well, things like exchange rate. And so with that in mind, you can then allocate your portfolios to something that suits your risk profile. It can be something that you want to be a little bit more aggressive, put more exposure into foreign stocks. Or it can be something that's a little bit more conservative. You want to put more exposure into local, safe, blue chips and REITs. Stocks that will give you dividends and stocks that will give you an income, depending on what your needs are. So of course, if you want to do this kind of asset allocation, again, you can talk to a trading representative, you can talk to your banker with OCBC maybe, and I'm sure they'll be happy to help you out with that. But this is just the entire concept of it on a portfolio or individual level. Now, the other thing that we always consider when we are looking at buying and selling a stock is not just in terms of size, but actually what the company is doing, what the stock of that company is exposed to when it comes to sectors. So sectors, what are they? I'm sure many of us intuitively, we kind of know, okay, there are different sectors out there. For example, the airline sector, or for example, the energy or oil and gas sector. So these are some classifications that could be useful for us, because when we know what sector a stock is in and we know what its peers are, then we know how the stock is doing relative to its peers. So there are many different classification standards out there, but one of the most well-used ones is the MSCI GICS, a global industry classification standard. Of course, we wouldn't go into all the details, but these are just some examples for you to also think about that might tickle your brain. When we talk about sectors, we talk about energy sectors, of course, what comes to mind would be our oil and gas names. And so maybe at the petrol kiosk, you have seen some of these names before. ExxonMobil or Mobil, Esso. We have seen Shell. We have seen maybe even PetroChina. Or looking beyond these names that we are familiar with, there might be companies like Keppel that are not officially in the energy sector, but they used to produce oil rigs, and they used to be one of the world's largest manufacturer of oil rigs. And so companies in the energy sector, of course, would tend to be exposed to something like oil prices. And as you can see in the recent environment with Russia and Ukraine, there has been a lot of volatility, and so these names have been impacted the most. Of course, they're also exposed to other factors out there like interest rates, like inflation, but it's good to know what your stock is at least exposed to. Even if officially Keppel might be classified as an industrial name, it could be exposed to oil prices, or maybe not so much anymore because they decided to move away from oil and gas into renewable energy. Next, of course, we look at financials. Some of the names that we are familiar with, JP Morgan, some of the US banks, Citibank, for example, DBS, UOB locally. Also our insurance names like Ping An Insurance in China, or even companies that are dealing with insurance in the US or in Hong Kong. So these are some of the names that we might be familiar with. And of course, financials, then again, what they're exposed to as a sector, things like interest rates. Very quickly now, IT, we might look at companies like Apple, Microsoft, in Hong Kong, Xiaomi. Locally, a company like Venture, which is not quite the same. They don't do services so much, but they do manufacturing for electronics. And so they're still classified under IT. And real estate, we have companies like Evergrande, very famous recently. But of course, locally, we have companies like UOL. We also have companies that manage REITs, like CapitaLand Investment, because CapitaLand recently split off their investment and their property construction arm. So companies that are in a sector might not always do the same thing as well, but they tend to be exposed to the same kind of risks, same kind of factors out there. Now, lastly, of course, we look at these examples of consumer discretionary just to get an idea of how this could be something that could be a little bit more complicated than what meets the eye. Companies like Amazon and Alibaba, for example, started out as consumer discretionary because they are e-commerce companies. But beyond that now, because they are conglomerates, they have put their fingers into many, many different technologies out there. Some people classify them as technology companies, especially for companies like Amazon with Amazon Web Services or AWS. So companies like Tesla also, they are classified as consumer discretionary because of their electric vehicles. Any car company is usually classified as consumer discretionary, but they market themselves as a tech company with over-the-air updates of their vehicles and things like that. So it's always important to know not just the sector, but also what the company is talking about, what the company is all about, actually. And lastly, of course, healthcare, some of the names that we are very familiar with. I wouldn't go too much into detail for that. So I've been talking quite a bit, and now actually I'll just have one more section before we open up for some Q&A. We are going to be looking at what moves the market. And that's actually a sneak peek for what we'll go into a bit more detail for our next session for Why Trading Matters Part 2. But what moves the market? So we've talked about some of the things to look out for when it comes to the stock market. Things like sectors, things like market cap. But what moves the market? This could be something that's a bit more interesting to many of us. So first of all, when we dig into equities, we talked about sectors, but there is another concept that we might want to be a bit more familiar with as well. And that's the concept of factors. What exactly are factors? Well, there are things that affect your stock market, and factors is a nice way to put it, but it's basically the whole idea about investment concepts. And it's gotten very popular recently. We have people talking about things like smart beta, which is actually also all about factor investing. But the whole idea is, for example, we have these 4 factors here by MSCI that has been classified. Quality, momentum, value, and size. And these just refer to investment concepts or styles. So quality, for example, is the investment concept of buying good companies, companies that are financially sound. So companies that have good balance sheets, companies that are generating good cash flow, generally they don't have problems with their debt, things like that. There's another style called momentum, which is the whole concept of actually buying into winners, buying into those in the stock market that have consistently outperformed. So it could be the biggest outperformer in the stock market for this quarter, for example, and you just buy into it. The reason, of course, is because this could be something that you're interested in because the winners won for a reason. So this stock market momentum idea is I buy into a stock that has been going up because there's a reason why people want it to go up, or people have been buying into it as well. Remember, you're always not alone in the stock market. And you have other people who you can tap on. People that you see are buying into the stock. You think, oh, now there's momentum for the stock. This could be one trading or investing style as well. Now, thirdly, we have a concept of value. And the value concept is really to buy stocks that are relatively inexpensive. So there are certain ratios out there that the market uses. For example, PE or price earnings ratio. And if you compare these stocks in terms of their peers. For example, you compare the three local banks, DBS, UOB, OCBC, you might say this stock is cheaper than the other stock based on this ratio. That's the whole concept of it. Now, lastly, of course, we have the size factor. Now, we mentioned a bit about it in terms of market cap just now, but the whole idea is that small caps, although they are a bit more volatile, they might have a bit more uncertainty to them, they also have more room to grow. Think of it as a company that has huge potential but hasn't quite reached it yet. So this could be a factor that you might be interested to buy. Just think of it as it's easy for a small company to double in size, but it's difficult for a company like Amazon or Apple, these mega caps, to double in size. Even if you look not at small cap, but you look at, for example, Shopee or C Limited, for them, maybe they're at a market cap of about 100 billion. It's huge. But for them to go from 100 billion to add on 100 billion market cap to become 200 billion, to double in size, is still going to be easier than for a company like Amazon in the $1 trillion range to double in size and add on 1 trillion more in terms of market cap. So different factors tend to win or lose across different market conditions. And factors are a key driver of risk and return. There are many academic studies out there, but this is just putting a name to some of the investment concepts out there. So there are algorithms, there are traders out there that actually purely trade based on these factors as well. But we won't go too much into these academic studies as well. But this is a concept that you could keep in mind. It could give you a handle on what you want to start out with. Maybe you could start by going into momentum or going into value and see if that works for you and see if that's something that you are familiar and comfortable with when you trade the market. Now we talk about what moves the market. Other than factors, of course, we look at prices, and we won't go into too much detail because we'll save all the juicy stuff for our next webinar as well. But just briefly, so that you have an idea of what we will be talking about in our next webinar. So we look at the whole concept of demand and supply. Those of us who took econs in JC will be familiar with that as well. Demand and supply, and where it meets would be the price. And so there's this concept that's very popular among technical analysts, that's very popular among traders as well. And we have this legendary trader, John Murphy. He actually wrote many books out there. He's one of the most famous technical analysts out there. He was the chief technical analyst for stockcharts.com. He came up with this saying that says, market action discounts everything. Prices tell you everything. Prices reflect everything that there is to know, whether it's in terms of news, whether it's in terms of market expectations of your company earnings, or maybe even the actual earnings themselves in your accounting balance sheet. It could be economic indicators, market sentiment, the policies that investment analysts are projecting will come from the government that could affect your stock. Prices reflect everything. So that's at the very heart of it. What would affect the price is going to be priced in terms of what news could be out there, whether good or bad. You price that in. What policies are out there, you would price that in. Even psychology, market sentiment, you would price that in. People are very excited about the potential of a stock, maybe in the EV space, that's being priced in. And so some things might be affected, like your ratios, like your valuations, but all of that will come into the price at the end of the day. We will look at three key areas: news, fund flows, and macro environment in terms of what moves the market. Next session, we'll look at, especially in terms of how many things could be affecting a stock price all the time. There could be positive news, but there could be negative fund flows. And as a trader, as an investor, it's up to you actually to figure out where the market is heading based on all the information that's available to you out there. So we will be providing you with some handles on what to look out for, especially. When it comes to news, actually, news can be general, specific. It can introduce new information in terms of what the earnings outlook could be. It could tell you what the government is going to be spending in fiscal policy, or the central bank in terms of hiking or cutting interest rates. It could be macro news. It could be political news. It could be news relating to the company itself, or maybe even what certain analysts from certain investment banks think about a stock. We'll go into detail in the next session. Same thing for fund flows. It's something that traders look at. It's what other market participants are looking at in terms of what they are buying and selling. And of course, what some of the market participants are doing. Different market participants, you have your pension funds, you have your day traders, they will act differently based on what they see in the market. And so for the discerning trader, you will look at some of these flows, some of these fund movements, and be able to tell what the outlook is for that particular stock or that particular market. So some examples in terms of the equity indexes, we're talking about in terms of volume and turnover, we'll go into the details in the next session. Now, lastly, of course, macro environment, that's something that's very important, especially to this investing style called top-down. So the bottom-up approach is for people to look at things like your accounting balance sheets. The top-down approach is to look at the macro environment, and it's certainly something that will affect your stock because it affects your company's earnings, it affects your company's business decisions, it affects how the stock market as a whole could be impacted. Even something like taxes, even something like in terms of inflation. These are economic indicators, but they are things that affect your stock. So things like interest rate, bond yields, gold, volatility of the market even, or the futures and FX outlook, oil and commodity prices, these are things that are happening broadly that could affect your single stock as well on a narrow micro basis. So this is a sneak peek actually of what we'll be covering in the next session. Hopefully that you guys will be interested and you guys will be able to actually join us for the next session when we dive into what moves the market and looking at all these indicators, comparing them against each other. How can you tell what's important in all the news out there, what's important in all the indicators out there? So we've come to the end of today's webinar session actually. And like I mentioned, we'll be having a next part of our Why Trading Matters part 2 webinar happening on the 21st of March, the third Monday of the month. But before that, next week, actually next Monday, we have a session with my colleague Samuel, and he'll be talking about why, like in terms of trading matters, he will be looking at the current environment. So those of you who are interested to trade right here, right now, you will be interested actually in looking at what Sam will be sharing next Monday, because he will be going not so much in an educational aspect, but actually looking at the current market sentiment, the current outlook for interest rates, the current outlook in terms of geopolitics. What happens if Russia-Ukraine comes in, or maybe not? Things like that that are very recent, very current, and very relevant to us in this day and age. So Trading Matters with Samuel happening next Monday, and then after that, following month, of course, the part 2, we'll be talking about what moves the markets and why Trading Matters part 2. If you have any questions from today's webinar, you can of course contact your trading representative. These are some instructions, or you can just leave us a chat in the chat below. Leave us a message in the chat below in the Q&A box, and we'll be happy to connect you with your trading representative as well. So you can just log on, ask them any questions, or ask me any questions in the chat or Q&A box as well. So thank you so much everyone for joining us. We've actually come to the end of our webinar, and now I'll be taking a look at some of the questions that you might have in the chat or in the Q&A box. Try to answer them, but of course my apologies if I'm not able to respond to many of you, because this is in a broad webinar setting. I might not be able to respond to every single question. Then do check in with your trading representatives as well, and I'm sure they'll be happy to advise or to guide you. Even for something that's a bit more administrative, how to open an account, how to place my trade, things like that, they're here to help you. So with that, I've ended my presentation. I'm going to take a look now at the Q&A box as well as the chat box. So you can continue to put your questions in if you have any questions, or maybe even things that you want to see in the next webinar session, so that we can actually respond and we can prepare material and answer these questions that you might have and help you along the way. Okay, so let me take a look now at the chat box. Okay, so in the chat box, actually, we have some questions that are related to trading specific. Like I mentioned, I think it would be better for your trading representatives to actually answer you directly in terms of how to execute a trade, in terms of what are the dates or timings or to look out for in terms of settlement periods, things like that. So some of the questions, I think you might want to direct them there, or otherwise you can actually call into our hotline as well. There are some questions also that are related to, I think, individual companies when it comes to the outlook. So when you are talking about the outlook of individual companies, again, it will be best to discuss that with your TRs because they will be very, very familiar with what kind of individual stocks that you are interested in. Okay, I believe my colleague Samuel has also responded to many of the questions that you might have had in the Q&A box. Are there any other questions? Okay, there's a question actually related to trading volume, I think, talking about the percentage of participation by institutional investors and retail investors. I don't have the percentage with me offhand, but I think one of the topics that we will cover in future webinars is actually talking about different characteristics of in terms of investor participation when it comes to retail and institutional. So for a market like, for example, China, onshore China, Shanghai and Shenzhen stock exchanges, the participation of retail tends to be a lot higher as compared to in the US. So that's something to look out for because as you have seen in 2015 in the stock market bubble, boom and bust, that does affect a lot of the trading. In the US, actually, we have seen the retail trading pick up significantly over the course of the pandemic. And I think it's quite heavily covered in news outlets as well. When it comes to retail participation, there are people that are positing that, retail traders have been coming in because they're locked down at home. Maybe now not so much because things are opening up. But the retail participation has actually come in and it actually peaked during the meme stock frenzy in start of 2021. When we're talking about stocks like AMC or GameStop, retail participation was actually driving a lot of the market at that point in time. I don't have the exact percentage, but I do believe that the percentage actually went up significantly. But there has also been news that a lot of this retail trading craze has died down. So actually institutional investors are back in charge right now. Of course, that doesn't mean that the retail investors can't come back because if they have already created an account with companies like Robinhood, for example, all they need to do is again place a trade. But we have seen the participation numbers come down. I don't have an exact percentage for you, but that's the current trend right now, that institutional investors seem to be back in charge in the US and things are becoming a lot more rational, you could say. So different institutional and retail investors, they tend to look at different things. The retail investor might be following a trend or craze. Institutional investors could be following fundamentals like earnings a little bit more. And of course, the big difference is when it comes to risk management, because institutional investors, they have a mandate that an institution tells them to do. So it could be things that they can and cannot buy. It can be things that retail investors might not be looking out so much for in terms of percentages that they are allowed to lose when a stock comes down, for example. So things like that, I won't have the exact numbers for you, unfortunately, but they are points for you to consider as well. And if you have any questions about that, I think you can ask, or you can do a quick search, or otherwise in the next session, maybe I'll be able to cover it as well when we look at what moves the markets. So we'll be looking at institutional and retail in our next session as well. Yep. Okay, I believe there aren't any more questions. I think there's a quick question actually on taxes. Sorry, I just missed that. When it comes to taxes, it depends on what markets you're actually trading in. So as far as I know, I don't believe capital gains is taxed in Singapore, but it is taxed in countries like the US. So for more details on that, do check in with your TRs about that because it is quite specific actually. It also depends on your tax residency, it depends on your status. You might have to fill in certain forms in order to participate in certain markets, or you might not be able to as well, depending on your citizenship and things like where you are getting your income from. So do check in with your TRs about taxes. Yeah, they will be able to give you more specific, personalized advice as well. And they definitely will be able to tell you even things like percentages, things like that. Yeah. Okay, I believe that's all the questions right now. So again, if you have any things that you want to see in our next webinar as well, for example, the retail institutional question, Do drop us some feedback. Do let your trading representatives know, and they'll relay that information to us as well. And we will be having our next session next month. So I look forward to seeing many of you guys there. So with that, take care, stay safe. We'll be ending off tonight's webinar session as well. So thank you so much, everyone, for joining us. And I hope to see you next week with Trading Matters with Sam, and the following month in March for the part 2 of Why Trading Matters. Thank you very much, everyone.